Imagine opening your credit app, seeing a 740, feeling like an absolute financial champion, and then walking into a bank to apply for a mortgage or a new auto loan, only to have the loan officer pull up a 690. That sudden drop in your chest, that wave of panic, that immediate feeling that somehow the system is broken or that you've been lied to, it's an experience shared by millions of people every single day. You didn't miss a payment, you didn't rack up crazy debt overnight, so why are the numbers completely different? The short answer is that you are comparing two entirely different categories of financial metrics that most people mistakenly lump into the exact same bucket. We live in a world where credit terms are thrown around interchangeably, yet nobody takes the time to explain the foundational mechanics of how these scores are calculated. The fundamental distinction comes down to understanding the difference between a credit bureau and a credit scoring model. Experian is a credit bureau. Think of Experian as a massive digital filing cabinet. Their entire job is to collect data about your borrowing habits from credit card companies, banks, collection agencies, and public records. They track your open accounts, your payment dates, your total balances, and whether you paid on time. Experian itself does not inherently create the rules of credit scoring. They gather, compile, and hold the raw data that forms your credit report. FICO, on the other hand, stands for the Fair Isaac Corporation, and they're a data analytics company. FICO does not collect your personal payment records directly from banks, nor do they track your bank accounts. Instead, FICO builds the mathematical algorithms, the complex formulas, that take the raw data sitting inside Experian's digital filing cabinet and turn it into a single, three-digit number. To use a simple analogy, think of your credit life as a student in a classroom. Experian is the school administrator who collects your test scores, attendance records, and homework assignments into a giant folder. FICO is the standard grading scale that takes all those records and converts them into an overall GPA. Experian holds the information. FICO calculates what that information means to a lender. So why does the confusion happen when you log into the Experian app or website? Experian offers a free score on their platform, but when they present a number to you, they're applying a scoring model to the data in their report. Sometimes, Experian shows you a FICO score based on Experian data. Other times, free credit monitoring services, including Experian's competitors or certain third-party apps, show you a number calculated using a completely different scoring system called Vantage Score. Vantage Score was created as a joint venture by the three major credit bureaus, Experian, TransUnion, and Equifax, to compete directly with FICO. This is where the massive gap occurs. Over 90% of top lenders in the United States use FICO scores when making actual lending decisions. You have dozens of credit scores depending on which bureau's file is being analyzed, Experian, TransUnion, or Equifax, and which specific FICO or Vantage score model the lender chooses to run against that file. However, despite all these moving parts and different algorithms, you do not need to stress about gaming 50 different formulas. Every single scoring model, whether it is FICO 8, a specialized FICO auto score, or Vantage score, is built around 5 core pillars of financial behavior that sit inside your Experian, TransUnion, and Equifax credit files. The first and most critical pillar is your payment history, which accounts for approximately 35% of your FICO score. This evaluates whether you pay your bills on time. A single 30-day late payment can cause a severe drop in your score because it signals risk to future lenders. The second pillar is your credit utilization ratio, making up about 30% of your score. This measures how much of your total revolving credit limits you are currently using. For instance, if you have a credit card with a $10,000 limit and your statement balance is $3,000, your credit utilization is 30%. Keeping this percentage below 10%, and certainly below 30%, is one of the fastest ways to optimize your score across both FICO and Experian reports. The third pillar is the length of your credit history, accounting for 15%. This looks at the age of your oldest account, the average age of all your open accounts, and how recently you've used them. This is why closing your oldest credit card can actually hurt your credit profile, as it shortens your average history over time. The fourth pillar is your credit mix, which represents 10% of the formula. Lenders like to see that you can responsibly handle a variety of debt structures, such as a combination of revolving credit like credit cards and installment loans like auto loans, student loans, or mortgages. The final pillar is new credit, accounting for the remaining 10%. This tracks hard inquiries, when a lender pulls your credit file because you applied for new credit, and the total number of recently opened accounts. Opening several new credit cards in a very short window flags you as a high-risk borrower and temporarily drags your score down. If you are planning a major financial move, such as buying a car, applying for a mortgage, or requesting a premium credit card, your actionable roadmap is straightforward. First, stop looking strictly at the 3-digit number provided by generic tracking apps without checking what model it is using. Look for the fine print that tells you whether you are viewing a FICO score or a Vantage score. Second, pull your actual, detailed credit reports from Experian, Equifax, and TransUnion via annualcreditreport.com to ensure there are no errors, fraudulent accounts, or incorrect late payments dragging down your file. Third, focus on the fundamentals. Pay every bill on or before the due date. Pay down balances prior to your statement closing dates to keep reported utilization low. And avoid applying for unnecessary credit lines in the months leading up to a major loan application. Understanding that Experian is the repository holding your financial data, while FICO is the analytical lens through which lenders view that data, strips away the mystery of fluctuating credit numbers. When you master the core habits that improve your overall credit health, every score generated from your file, regardless of the version, will naturally follow upward.